Let's now focus on financing activities. Cash flows under financing activities involve cash associated with changes in long-term liability and shareholders' equity items, which means under financing activities, we can have cash flow items such as cash from issuing debt and repaying the amounts borrowed, cash obtained from stockholders, cash associated with the repurchasing of shares, and cash used to pay dividends. Now, under cash inflows in the financing activities category, we have examples such as cash from the issuance of common stock. And for XYZ Corporation, we see that it issued 215,000 worth of common stock. We can also have cash inflows such as cash from the issuance of debt instruments such as bonds and notes payable. We can also have cash outflow items, and such negative cash flows under financing activities may include repayments of debt issued, repurchases of stock using cash, and dividend payments. Now, note that companies that enjoy relatively stable cash flows can afford higher debt levels because there is some assurance to creditors that future cash flows will be sufficient to cover debt repayments. We will now discuss the articulation of financial statements. Articulation refers to the fact that the four financial statements are linked to each other and that changes in one statement affect the other three. So let's look at some examples of the linkages between financial statements. Now, the cash balance in the statement of cash flows is linked to the cash balance on the balance sheet. Net income reported on the income statement is linked to the statement of retained earnings, which in turn is linked to shareholders' equity and the balance sheet. We will now focus on principles and assumptions in financial accounting. Let's start off with the full disclosure principle. Under the full disclosure principle, financial reports should include any information that could affect the decisions of external users. Now, this should be subject to the cost effectiveness constraint, which implies that we should be mindful of the cost as we satisfy the full disclosure principle. Historical cost principle. Now, according to this principle, asset and liability measurements should be based on the amount given or received in the exchange transaction, which is historical. Now, note that the historical cost measurement provides important cash flow information, and it is also highly verifiable. Now to the realization principle. Revenue should be recognized only after the earnings process is virtually complete and there is reasonable certainty of collecting the assets. Now, this indicates that the realization principle applies to revenue recognition. So, revenue should be recognized in the period it is earned, not necessarily in the period in which cash is received. Next is the matching principle, which is an expense recognition principle. Under the matching principle, expenses are recognized in the same period as the related revenues. This implies that we match expenses with the related revenues. Next is the going concern assumption, which is in the absence of information to the contrary, it is expected that a company will continue to operate indefinitely. So what this implies is that as we read the auditor's reports that accompany the financial statements of a company, we should be alert for any comments that suggest that there is a doubt that the company will continue to operate as a going concern. Periodicity assumption. And this assumption is that the life of a company can be divided into artificial time periods, and this is necessary to provide timely information to external users. So we divide the life of a company to, for example, fiscal year periods, 2013, 2014, 2015, 2016. And for each of these periods, we are able to provide timely information to external users. The monetary unit assumption. Now, according to this assumption, financial statement elements, or the items reported in the financial statements, should be measured in terms of the reporting currency. The economic entity assumption. Now, this assumption is that all economic events can be identified with a particular economic entity. So when we look at the financial statements of a company, we expect that it captures all economic events for that particular company. Our final discussion will be on disclosures and notes that accompany the financial statements. Disclosure notes including a summary of significant accounting policies, description of related party transactions, and notes fashioned to suit the disclosure needs of the reporting enterprise. The summary of significant accounting policies is an important section within the notes that accompany the financial statements. The reason is that the summary of significant accounting policies convey valuable information about the company's choices among various alternative accounting methods. Note that the alternative accounting methods are allowed. So a company chooses among the various alternative methods. for one particular account reporting. So for example, a company may either choose the straight line depreciation method or double declining balance depreciation method. We can also talk about the choice of inventory valuation method. So for example, a company may choose the first in, first out cost flow assumption when valuing inventory. This is the FIFO method. So we need to know all these, and it is the summary of significant accounting policies that conveys that information. Now, the economic substance of related party transactions should also be disclosed, and the amounts involved in the transactions between a company and individuals and other companies that it has a relation with. Now let's look at the management discussion and analysis section of the disclosures. The management discussion and analysis section provides a biased but informed perspective of a company's operations, liquidity, and capital resources. Note that this section is biased because it is management's perspective. There is also the management's responsibility section, and in this section there is an assertion by management of their responsibility for the information contained in the financial statements. It also includes an assessment of the company's internal control systems. Now, the internal controls are the systems and policies and procedures that are in place to ensure that the financial statements are fairly reported. Now, the management's responsibility section also states the responsibility of the auditors to attest to the fairness of management's financial statements. Finally, there is the auditor's report that provides an independent and professional opinion about the fairness of the representations in the financial statements. It also provides an independent and professional opinion about the effectiveness of the company's internal control over financial reporting. This ends our lesson.